Let's understand the derivative-specific compliance requirements. As we know, BFSI or Banking, Financial Services and Insurance is one of the most heavily regulated industries across the globe, probably on par with healthcare. So what are the specific requirements if we are dealing in derivatives, trading, clearing or settlements? In India specifically, we need to have some specific compliance requirements known to us, because compliance requirements or regulatory requirements are always geography specific. One thing we have to understand is that OTC products or over-the-counter products, where two parties enter into a custom contract with each other, are by nature more complex because they are very specifically designed contracts, and then there could be more compliance requirements in those products. So let's understand compliance requirements in India. I'll classify them broadly into 6 categories. One is, what is the regulatory structure around derivatives? What are the documentation requirements around derivative products? What are the credit support and collateral requirements? What are the due diligence specific requirements in derivative products? How do you handle losses when it comes to derivatives? And what are the taxes and duties specific requirements in the derivatives products? So first and foremost, let's look at the regulators and the regulatory structure of derivatives market in India. As we know, SEBI is the key regulator for the derivatives market. SEBI is responsible for implementing Securities Contract Regulation Act, which is one of the very key objectives of SEBI. So we need to understand the SCRA or Securities Contract Regulation Act requirement very well when it comes to trading in derivatives. Likewise, RBI, another key regulator in India, has implementation responsibility for Foreign Exchange Management Act or FEMA, and also of various circulars and directions issued by RBI when it comes to currency derivatives. IRDA, the insurance regulator, Insurance Regulatory Development Authority of India, has specific regulations for insurance companies that participate in the derivatives market. For example, around interest rate swaps that insurance companies enter into to manage their interest rate risk. Then there are exchanges and clearing houses like Bombay Stock Exchange, National Stock Exchange, NCDEX and other exchanges where derivative products are traded. They have their own specific requirements around trading, clearing and settlement. We have SROs or self-regulatory organizations which are member bodies like FBIL, Financial Benchmarks India Limited, which produce data on the underlying assets. For example, what are the interest rates or what are the currency rates, and these are taken as a benchmark for valuation and settlement of derivative products in those specific assets. Then we have ISDA requirements or International Swaps and Derivatives Association requirements. This is a US member body where they have specified standards for documentation, clearing and settlement of derivative products, specifically OTC derivative products. This ISDA documentation is used in India also with certain modification. The second requirement is around documentation of the derivatives transactions. ISDA master documents, as I mentioned, we need to understand them well and how to customize them specifically for our requirements. Second is, we should know which documents need to get notarized or authenticated by a government appointed notary. What kind of board resolution should back up the contract? For example, if I am signing a contract, then is my board, what kind of authority my board has given to me, for example, to sign that specific contract? We need to get the copies of those board resolutions as well. We should be careful what is the jurisdiction mentioned in the contract for any kind of legal issues that come up. If you want to take counterparty to a court or the counterparty takes you to the court, which court in which country, for example, is going to decide on this matter, where the first suit will go. Also, most contracts specify arbitration requirements. Who is going to arbitrage if some dispute comes up? Typically, arbitration is preferred by the commercial, the commercial contracts by counterparties, because it can settle issues rather than going through the extensive, costly legal process, right? So, but who's going to be the arbitrator, etc., has to be very clearly defined in the contract. So, this is around the key documentation requirements. The third set of compliance requirements are around credit support and collateral. What is credit support? Whenever you are entering into a derivative contract, you have to prove your credit worthiness, right? So in that case, what kind of documents or what kind of collateral are you going to furnish to enter into a contract? Typically, the preferred collaterals are government securities because their price fluctuation is relatively less. They are more stable. They are liquid products also, right? Or cash or foreign exchange currency. These are typically the well accepted collateral in the market. there are margining requirements specific to derivatives. For example, if you are dealing in the derivatives on a recognized stock exchange like NSE or BSE, then in that case, there are margins that you need to pay upfront before taking position in the derivative contracts like futures and options. Likewise, there are various margins collected at different points in time. For example, if there are market fluctuations, the price goes up and down, you may have to pay mark-to-market margins to make up for the losses that are likely to be incurred because you have that position in the derivatives contracts. Likewise, in case of extreme volatility or a lot of price fluctuations, the exchange may collect additional margins like VAR margins or value at risk margins or extreme loss margins also from you. So you need to have proper software, tools, etc. that can do these kind of complex risk calculations. So that models have to be built into those those softwares, so you can anticipate and you can have requisite collateral or security ready with you. Those algorithms have to be ready with you. You should have sufficient capital of your own, right? So capital adequacy norms you have to monitor very carefully. If you are taking positions on behalf of the client, you should take adequate margins or security from your clients if you are a broker in the derivatives market. Also, you might have to monitor your position in the market. What is the open interest? What are the contracts for which you have liability? Or you might have to make some kind of a fulfillment. Or you might want to square off some of the open positions in the market and use the netting to your advantage. So these are the things that you need to monitor specifically on the credit support and collateral side. The fourth important requirement in compliance is around due diligence. What is due diligence? Is what steps you are reasonably expected to take to make sure that all the contract requirements are being taken into consideration. For example, if you are a bank or you are a derivatives dealer, you are an investment bank, then you have to do know your customer or KYC for your customer. So you might have to collect specific documentation from the customer like company incorporation certificate, the PAN numbers, the GST numbers, the various kind of registrations that the company has. Then you might want to go through their annual accounts to look at their balance sheet size, and you have to take care that you satisfy also the appropriateness and suitability requirements. If you are a broker or an investment banker recommending a product to your client, you have to make sure that those products are suitable. You have to create adequate documentation, because tomorrow regulators might ask you, why did you recommend this product when it was not suitable or appropriate for the customer and was not in line with their risk appetite. Also, you have to make proper risk disclosure to the clients. Derivatives, though, are designed to manage risk, they themselves are complex in nature, so they themselves create some risk if the client doesn't understand the risk in the derivatives products correctly. So those risk disclosures have to be made to the client and you have to get their sign off. Also, if you are creating any kind of a derivatives contract, new kind of products, then you have to get the sign off from your own CRO or chief risk officer or maybe chief compliance officer to make sure that the product complies with all the necessary requirements. So these are the kind of due diligence requirements that you have to take care of if you are offering derivative products to your clients. You also need to know how to handle losses in case there is some kind of an event in the market. For example, in India, we have insolvency and bankruptcy code, which might become applicable if you are dealing with a counterparty bank or some other financial institution or some other corporate. You should know, how the administrator, if that administrator or liquidator is appointed, how do they work, how to deal with them, how they typically close out the positions open, on behalf of the party which has gone bankrupt, and what is the hierarchy of settlement, who gets the money first, who gets the money next, and so on and so forth, so that you can recover your money as much as possible. So this is around handling of the losses. And last, you need to understand the taxes, duties and other stuff involved in the derivatives contracts. For example, what is considered as business income, for example, for an investment bank or a broker firm, and what is considered as a business income or other income for the corporate, right? Those things could be different from the income tax point of view. And what can be carried forward, for example, by way of losses. Also, speculative transactions versus the transactions entered on the recognized stock exchanges. Those IT authorities look at these two differently. You have to understand if there are any withholding taxes or what we call TDS in India, tax deduction at source requirements, and you have to fulfill those requirements, deduct those taxes and pay it to the government. And one more important thing is there is a securities transactions tax, right? So which you have to make sure that you are paying, and then you are getting the necessary credit in your account for having paid the taxes. So these are the broad compliance requirements when it comes to derivative products dealing in India. Knowing this risk is very important because without understanding the risk and compliance requirements, if you enter into derivative contracts, you might suffer a lot of legal consequences. Knowing this will help you identify roles and opportunities in the compliance field in the derivatives market, because these are by nature very complex. If you understand these requirements very well, you'll have more demand for your career will be much better. I hope you found this video useful, and if you did, then please like this video, share with your friends who might find this useful, and also do subscribe to my channel. Thank you very much. Cheers.